There he is. Good afternoon, Michael. Holy shnikes. From the top ropes, my friend. Pretty please. Jump right in.
I just wanted to, just let everybody know today who this is when we're talking together. So you guys can make whatever you want with it, but you're not going to see anybody else do that ever.
Ever. That was like to say that there was a reversal from the top for you to be able to have all of that, to take that trade. Again, no one does that. Not in these market conditions.
Wild. It's wild.
Yeah, it's neat. It's neat. So how's everybody doing? Everybody doing well?
Great.
Yeah.
I had to babysit that son of a bitch thing. I had to drive up the street to grab something. So you'll see 2 times I go in with a single because I'm managing it from my phone. And I'm like, I wanted to put more on, but I was afraid if I put it on, I wouldn't be able to get connection where I was driving because we have a lot of trees around here. And it was, I wanted this thing to pan out so good today. And it was lovely, absolutely lovely. So to the boys out there that were challenging me yesterday, come get your shit because I'm ready.
Bro, I don't think there's anyone anywhere. I can't even imagine people that do that. But then the fact that we have the open forum here for folks to come in, it almost, it invites the trolls. Like, oh, you got something to say? Well, we'll turn on this space called Trader Roundup. We'll give you a speaker tag and let's hear what the fuck you got to say. Yeah. So, and while we're at it, let's see if you got any kind of trades or anything to back up anything you got. And we all know they don't. So
exactly.
Anyway, I want to jump right in, Michael. Maybe we could get something from someone else. I mean, just like the vibe from the room at all. I mean, we've got a couple folks here. What are your thoughts? I mean, I see a couple hands up, maybe. What are your thoughts?
Do we have that fellow from yesterday? We owe him a... Is he in?
That's a great question. I'm trying to let me look in my DMs. Oh, that's not going to be a great place to look. Do we know his name? I'm trying to remember. I wonder if I can look in the comments if anyone has.
Didn't it begin with like a B or something?
Yes, it did.
Byron, something. I don't know, to be honest.
No, you're right. It was Bhesi, I believe. Behesi or something.
Like that, yeah.
Anyway, I don't see him here at the moment, but we do have a few gents here. Sense would like to come up and El Ingobernable. So maybe Sense, you want to jump in? You got thoughts or 2 cents here?
Yeah, how's it going, guys? Can you hear me?
Yes, sir, we can. Welcome to Trader Roundup.
Appreciate it, man. How's it going? How's everyone doing?
Pretty good. Did you catch that trade Michael just took?
I did, actually.
Whew.
I did. That was a nice one.
Groovy. Did you got any questions, thoughts, 2 cents?
Yeah. Well, first off, just to follow the rules,
Thank you.
Most people call me Sense. And to start off, just trying to find the right way to word this. So I did have a question regarding the 2022 model. And my question is, when you have a clean 2022 model setup and you see it, but your TP is beyond an imbalance tied to a key 4-hour macro, like the 150 to 210 macro window. And, you've seen price react there consistently, let's say like bullishly in this case. How do you determine whether the level is going to reject again and maybe like stop you break even or hit your stop loss on the 2022 model, or if it's finally going to get run through, assuming the market conditions are tricky, because I know one's supposed to apply context from what you see is happening and how the market's been behaving. But I find myself conflicted sometimes because I've traded the 2022 model for so long, but these key 4-hour macro windows are so powerful. When I extend them on my chart, I see price react to it time and time again. Like today, it reacted like 3 times. 930 reacted to it very strongly.
Can you guys hear me?
Hello? Yes, we can. You did fall off and you came back. Yes, sir.
Oh, do you want me to repeat the question?
No. Hold up, Sense. Are you back, Michael? You good? I see you falling off, falling on. There's definitely tech issues. Are you back?
I'm looking at your thing here, Kitt. If you can hear me,
I
can't hear you.
I can. I can.
Do like
I
an
can.
emoji.
I can. I can hear
Okay,
you.
do thumbs up again. Okay, that means you guys hear me. I can't hear
Yes.
anything.
Yes. 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 We can hear.
Let me sign out and come back in. Okay.
Okay. Yeah. Yep. Yep. Tech difficulties, they happen every day. Since we're just going to have to just throw that question into the abyss of whatever was, and we'll come back to it.
It's all good. Just whenever
Yeah, dude, we're
the
just
issue
trying to
solved.
figure this whole thing out, and power down, power up. We deal with it.
For sure. I'll be here.
Yes, sir.
Sorry, I'm not sure what's going on, but I heard. How you doing? How's everybody doing? And that's it.
Okay, Sense, feel free to tap back in, brother.
Okay. Can you hear me now?
Yes, sir.
Okay. So my question was, when you have a clean 2022 model setup, but your TP is beyond an imbalance tied to a key 4-hour macro, like the 150 to 210 macro window.
Help me see it in my mind. Are we shorting or are we going long?
Let's say that the imbalance in the 150 to 210 macro window is consistently creating a bullish reaction every time price taps into it, right? Because today, for me, the way I have it marked out on the 5-minute, it's a gap on the 5-minute in the 150 to 210 macro window, and when
So
you extend
you
it
have a
out,
chart. You have a chart. You can hurry up and
Yeah.
post it. Do
Yeah.
that.
Yes.
I'm
Sense, do
I
that, buddy.
don't have a picture of it at the moment.
That's
I'm sorry.
okay. Well, you can't break protocol. I appreciate you. And coming up with technical questions without a picture breaks protocol and makes it difficult for everybody. So, and I understand we're freestyling here. You got another question? Got another comment? You got anything else? We can come back to this, and we know with protocol you got to have a picture first.
Well,
That's
try
it.
it. Try it. If I can follow along what you're saying, I'll do my best. But usually when you
Okay.
guys ask a question around the technicals or something charting,
Well,
just have
well,
something
how about
scribbled
this?
up.
Yeah, Sense. Can you screenshot or get something on into the purple pill or something maybe, and we can come back to you.
Yeah. Let's come back to me. Let's let somebody else have something real quick, and I'll have it.
Thank you, man.
Groovy.
I appreciate it.
Yeah, of
Yeah,
course.
man.
Appreciate your time, man.
Yeah, I appreciate you respecting everyone else's time, and we move on. El Gobernable, you're up.
Hey guys, how's it going?
Pretty good, buddy. How are you?
Not bad, brother. I'm happy to be here again. So,
Good.
I'm 20 years old. I've been trading around ICT concepts. I've been trading around over 1 year in the futures markets, just a couple of months, to be honest. I've been looking into different concepts since actually seen in an old journal the other day, late 2023. So, yeah, I've come a long way and the spaces are helpful, but I've got a couple questions here today, bro.
Go ahead.
So, regarding this new, because I'm going to start here, right? This new first sorry, brother, I've just got to word it correctly. First utilization of the fair value gap, right?
Yeah, first utilization. Yes, sir.
So today, is it helpful if I put a chart? It's from today.
It could help potentially. Yes, sir. I don't know where you're going with the question, so it's hard to say. If you have questions in regards to technicals, where a chart would be advantageous or beneficial to the conversation, pretty please add that to the
Yeah,
comment
sweet, for
section
sure.
for us, because then it makes it much easier to accompany the convo and we are efficient with people's time.
I mean, I'm not sure if you can see it. It's just a screenshot of so the one I'm talking about is the black highlighted box there, right? So that's the 925 1 minute suspension block.
Okay, I see your chart. I had to go at the very top. It said relevant. I had to change it to recent. And then the view activity on the right, I scrolled down. You were second down 29 seconds ago.
It's like a mobile app
Yeah,
screenshot.
no, I can see it, but can Michael?
I'm looking at a NASDAQ chart. Yes, it has a small, what looks like a gray box highlighting
Oh yeah,
around
that's the one,
27,000.
brother.
Yes,
Okay.
sir. Yes, sir.
Okay, go ahead.
Okay,
What's your question?
so I've managed to get like the words together now. So this is like pre-market open, right? But I've got my eyes on this gap here. It originally serves the purpose of an inversion. Then we sweep the liquidity from 914, and then it, you know, it acts again as an inversion and then taps into it again. I guess where I'm going with this is the first utilization of a fair value gap, of any sort of gap. Is it like, is there some sort of, what's the word, intricacy to do with whether it acts as an inversion or whether it acts as a normal gap? Like, could that give us more insight in like knowing what its first utilization was, or would you say I'm reading too far into it?
No, one of the benefits of having a target, okay, a draw, it doesn't necessarily mean it's going to be your session bias. It doesn't necessarily mean it's going to be the daily bias, but whatever you're aiming for, that target, that has to be the draw. So if you have that predetermined before you start looking for setups, when these fair value gaps form, for instance, say you're looking for sell side like I was today. Anytime we see a bullish fair value gap, the first utilization characteristic of that is that of if it trades above it and comes back down, one would reasonably expect it to be acting as a discount PD array to send price higher. But I would look for that to already, as soon as it starts booking and closes, once I have that in the chart, all three candles are there, I know that that's likely to be a factor to get short on once we trade down through it and come back up. So it definitely does. That's what's the whole purpose of having first utilization understood, because once you know where you're likely to draw to, every contrary PD array that would send price against that with its first utilization all become inversion.
So we're kind of looking at it from the perspective as where is the draw? Where is the session draw, the higher time frame draw? Not necessarily, it's not so salient because it's acted as an inversion or it's acted as a normal SIBI. Is that like the sort of thing? It's all about our draw on liquidity, basically.
As the first teaching that I taught, yeah, that's the most important thing. Know where it's going to go to next.
Yeah, so even if it's acting in several ways, inversion, back to a normal function, inversion again, that's useful to us as well, right?
I'm not sure what you're trying to say there. Like,
Oh, because this one I highlighted on the chart, firstly it was inversed, and then it was used later again as an inversion, and then
well,
later again.
the one you have highlighted, if I'm looking at it correctly, and forgive me, I have old eyes, so
Oh
that
no, that's
darker
fine.
gray, that's a sell side imbalance buy side efficiency, correct?
Yeah,
That's what you're highlighting. Okay, so
that's the
normally
one.
that the first characteristic for that would be bearish if it trades up into it. Once it trades
To
down
draw us
into it
lower.
and then draw it, and it does behave that way. But then we see it go above it. I can't see the time when it does it.
Would that be 9:35?
Yeah, I wouldn't be able to pull it out on your chart, but you know what I'm talking about, where it goes back
Yeah, yeah.
above it, and then it utilizes it as then an inversion fair value gap around 27,015-ish, and then sends it higher. So whatever the first characteristic it shows at formation, a down close candle, which is a SIBI, that's always utilized first as a premium array. You have to give it a chance to do that. But when it's opposing, for instance, if it was a sell side imbalance, buy side efficiency, if it's opposing a draw on liquidity that you think is going to go higher, the market's going to reach for something above where it's at right now, then you would expect it immediately to fail as a bearish one and then go into inversion that's bullish.
So I could forecast these inversions as well.
That's all I'm doing.
'Cause
Yep, that's all I'm
sometimes
doing.
I see myself doing that, and I'm a bit hesitant to get in, but then I'm like, oh goodness, you did it. You forecasted it.
It's all tape reading. That's the benefit of doing that. You'll desensitize yourself to that fear in the outcome, and it becomes like a flow state. You see it, you know what's going to happen. If your draw is correct, it's just a matter of just waiting for it to be there. And when time
Hey,
and price meet, you got to trade.
that's what the orange boxes are for, right?
Yep.
On the yeah. And Michael, brother, and Kit, I had one more thing. It's not. I'm generally not looking for, because you've told us many advice. You've told us a lot of advice, and now it's just something I personally want to ask, right? So generally I'm trying to trade with one micro, but there is times where I'm adding another micro to my position when I think it's favorable. And then, you know, I'm hesitating or I'm playing around with my stop. I'm getting stopped out at a loss or break even when I
What
could have been in
what
a profitable
merits or
trade.
what's meriting or validating you adding a contract just because you're feeling special? You're feeling good about yourself? Where
Now,
where where did that come from? You just
creations
decide to add it?
creations of order blocks, inversions, lower time frame, sub 1 minute fair value gaps, and I'm adding another contract, and then I'm getting stopped out with nothing, or you know, whereas with the one contract, I could have been more profitable.
And that's the key. That's why I've been telling everybody to just trade with one micro in this market environment. If you watch the trade I did today, I had to sit there and wait through a deep, deep, deep retracement before I started pyramiding a second stage for it. So unless you have a lot of experience and you have a really good aptitude to use multiple models, I think it would better serve you to just do one micro and babysit that thing to completion and get your baseline experience through this difficult market. 'Cause today was kind of hard. I'll be
Yeah.
honest with you. It was kind of hard. And it took a lot of focus for me to do this. You're not going to hear any kind of, I'm talking over the chart today because I mean, I was focusing and I had to leave the house for about 10, 15 minutes and come back. So there's no over the chart conversation. It's just, I'm sitting there looking at it, focusing. And there's a couple things you'll see in there, me annotating that I want to see it. I wanted to see it dive at one specific time. I wanted to see it do it quickly. And I had to weather a deep retracement, but it went back to an area where it made sense to me to add more. But someone that hasn't been doing it as long probably shouldn't be doing that right now. So what you're doing is the very thing I was warning you, if you did those things that you're trying to do in this market environment with not so much experience, you're building bad habits, you're building scar tissue, and you're retaining all these negative stimuli. And it's going to be a factor, even when the markets clean up and gets a little bit better, you're going to have that trepidation, you're going to have fear. Oh, what if it does it to me again? And that's why I'm trying to tell you, all of you, to trade with one micro. You'll make all the money you'll ever want once you get good. But right now, you have to be disciplined and you have to know what it's like to say, I want to do something else. I want to add something right now, but let's just put that as a paper trade off on an actual piece of paper and say, hypothetically, I would have done this, and then see what happens after that. But just manage to trade on that one micro.
I appreciate that. That feels like there's a bit of weight off my shoulders because I feel like maybe I'm trying to push too hard or rush something
You are.
because I
You
feel a
are.
bit yeah, I feel a bit guilty today. I took a trade and it was, you know, it was a good result, but again, it was a bit outside of my model. It was a bit outside of my trading times. I'm trading with like gap logic and looking at session to session liquidity, mainly 9:30 open. But I traded after 10:30 and I was looking just for like a target in the opening range. It worked out for me, but I feel a bit of guilt as well.
You should. And that's actually a good thing that you feel that way. That's your conscience telling you that you shouldn't have done that. And now because you feel that, don't beat yourself up and say, you know, I'm glad I feel off about not following my model, about doing things I shouldn't have done. You messed around, you found out, so don't repeat those things. Go back to one micro and grow. All the students that are benefiting right now and having a positive learning experience and developing soundly and the right way, they're all doing the one micro. Everybody that's
Yeah,
adding more to it, they're complicating things and they're bringing more outcome uncertainty to the exercise of developing experience when a market's really hard. So you're feeling exactly how you're supposed to. Don't beat yourself up. Just acknowledge the fact that, yeah, I should feel this way. It's good that I feel this way because you want to be able to feel that also 20 years in the future where you try to dabble outside your model to see how smart you are and it stings you and it takes something from you. You're going to feel the same thing then. You're like, I should have never done that. But you're not going to kill yourself over that. You're just going to say, well, I learned from it. Let me not touch that again.
yeah, maybe I'm just trying to make myself feel like you say sometimes, a release. Oh, because I know how to do this. I've watched the video how to do this. I've tape read this. Oh, I can do it. I can do it. But it's not having that strictness with myself, is it? It's not like self-discipline. I've got to
Right.
water the garden, you know, let the plants grow and flourish and see that one model work. That's right, isn't it?
Yes. You have to have humble beginnings in the start and let that time and experience develop on its organic basis, not force feeding it. Like I want to do more because I don't feel like I'm getting there fast enough. I don't feel like I'm doing enough. You're doing enough with one micro in this market environment. I promise you that.
Do you know what? I really appreciate that. And, you know, whatever like studies I can do on the charts and whatever, it's so helpful. But these sort of words help me as well because it's keeping me straight ahead and it's keeping me focused on what the true goal is. So, Kitt, Michael, thank you, my brother. God bless.
I'm glad it helped.
Thank you. Take care, guys.
One point Michael's made within your own rules, the process, your risk management, you really have no business awarding yourself a second micro, even within your study or within what you're doing. Just if you arbitrarily want to start trading with a second micro, I mean, your equity score, your model score, you've got to have something that substantiates why you would be adding a secondary contract. Otherwise, by default, the assignment is you trade with one, and that's the profile. You need to learn to deal with one, and then how to advance with one. And that's part of the exercise that Michael has provided for us. And he's also given folks parameters of where and how they could add additional, and that has to do with equity, right? Where how you would add a second contract is when you reach specific equity goals. He's gone over that with what he's done with his son and what you guys can do as well. Sense, you have your hand up. Go ahead, buddy.
Yeah, I just wanted to say that I have the images ready now. I didn't mean to cut you off.
Okay. Images in.
I'll send them in the chat right now.
Okay. Okay, good deal.
Because I know they can get lost when they're recent. So, can you see that?
I can see it, Sense. Yes.
Okay.
Well, let's make sure Michael can see it.
Yeah, I can't hear him right now if he's talking.
Is it two charts or is it something dividing one? I don't know.
It's
Okay.
just one chart. I just sent you a picture of the left side and then the right side of the chart because it's on the 5-minute time frame, so it's a little spread out.
Okay, I can see it. What's your question?
So that rectangle, the vertical one, is the 150 to 210 macro. So something I've been doing is marking out a notable imbalance within it, and I'll like extend it on my chart, which is the M1, just for macro one. It's the 4-hour key opening. So my question was, because they're really interesting to me now, but I've been trading the 2022 model for a while. So my question was, when you have a clean 2022 model setup, let's say in this case it's to go shorts, but this key 4-hour macro window imbalance has been providing a bullish reaction over and over, like it did today. You can see it in the image. I extended it, like at 9:30. I was wondering how I can determine whether that level will reject price again or finally get run through, like it did later in the PM session today. Because I have trouble identifying that at times, or I get like mixed feelings, and I'll sometimes hesitate and just simply not take the trade because I don't like to trade when I feel hesitation. So I was wondering if there's any guidance you could give me on that.
Well, obviously, the type of market we're in right now, we're at all-time highs. The natural tendency and the order of it is usually it will try to go higher, make higher highs. But those sloppy lows. When I was posting, that was Phil. Okay, so Phil's doing those failure to launch type runs real quick and make it look like it's going to sell off, and it's just going down into generally the rough area where you have there. But what that was doing was it was building sell side that they would target later on today. So when they took the buy side out, the highest buy side you have in your chart, once it did that and it did its standard little 3 drives high pattern, that's always a classic pattern I like to look for when these instances where all those wicks, those lows are digging into your little rectangle you've extended out to the side.
Mm-hmm.
When price is doing that and it just says, I'm not going down there yet, I'm not going down there yet, Most of the time, I don't have a percentage, but most of the time, even in all-time highs, I will take this trade. It will be there. It will be likely to draw down into it because everything was, I guess, being promoted to go higher. Everybody's wanting to see it go higher. Nobody wants to try to pick the top, tongue in cheek. The idea of it trading to that level today multiple times, it's engineering liquidity. So when it does those types of things, you have to see some kind of a climax reversal, and that can only happen when it trades to a high, breaks through it, and I like to see 3 times once it takes that buy side out. Once it makes a short-term high, then it makes another short-term high, and there's another short-term high, then it's primed to retrace and go back down into it. Prior to anything like that forming, it's not gonna be helpful to try to anticipate it doing it.
So would you say when you are watching price actively build an area of liquidity, look for that the 3 drive pattern, and then for a nice clean setup to form? Of course, using like more context in the market. Because I did short later on, but that's what I'm saying. Like, I felt a bit of hesitation, and I took one off once we got to that rectangle again.
Well, shorting. Let
Um,
me be fair, okay? What I did today and kept private while I was cooking it is because I had 2 goobers come to me on Twitter saying they're going to do something. So I wanted them to see what they'd be up against. Any of my students trying to short in this market right now is literally asking to have their head cleanly removed from their shoulders. So I don't want to give the impression that I'm trying to inspire all of you to try to sell short all-time highs. That I'm not trying to do. And if you go back to my old lectures, I've always been consistent with that. So of course, naturally, these people are going to say, well, why are you doing it? You're projecting the wrong message. No, I'm not. I'm projecting the fact that I know a little bit more than everybody else, and I'm just showcasing that. That's all. That's all I'm doing. But as a student developing how to do these types of things and trade, going long today would have been the easier thing for you to do. It would have been the easier thing to do. But you'd have to be aware of when it takes out buy side. If it's just making short-term highs, then there's another short-term high just a little bit above that, and it's pulled back, and another short-term a little high, and it's staying in a real small cluster of those highs above the buy side liquidity. And you can see what I'm talking about. I literally map it out in the recording. When it's doing that, all-time highs or not, if there's something to the left that they've left untapped, and what it was doing this morning was just that very thing. It was teaching them to look at price and say, you know what, this is strong support. It can't even go down there. Or you listen to the guy's name escapes me now, but Mr. Candlestick, the wicks tell you that it's accumulation. No, it doesn't. It's building gaps. And you saw what they did. They went right down there into that area. So that big pool of liquidity that was engineered with those wicks digging lower, digging lower, digging lower, and then finally moving higher, they're going to go for that. It's like a honeypot. There's so much interest to get it down there. And because they're selling short above buy side and every small little short-term high, that 3 drives pattern, that is real accumulation of shorts that will offset in that pool of liquidity and then down to the smooth lows I gave this morning.
okay. I understand. Would you say that when you do see like an area of liquidity be built within a 4-hour key macro window, like the 150 to 210 or the 550 to 610 macro window, would you say that it is higher probability for the market to want to target that area of liquidity if it's
Yes.
within that imbalance?
Yes. Because you're blending the best of time and price.
Okay. All right. I think that just about answered my question then. I really appreciate your time, Michael. And I also wanted to take a short amount of time to say how much Kitt's streams, along with yours, of course, have helped me and helped educate me and some of the people I know. I really think that everybody in here should tune in and try and be a good student. Like Pit Munch, your note taking is inspiring, and I can only hope to be a good a student as you.
You got to go through
So
law
I
school.
just want to tell people.
You got to go through law
I
school
just want
to get as good as
to.
she
Oh
does.
yeah,
It's
I
law
know,
school.
right?
Yeah.
I know. I just found that out today. It's crazy, but yeah. I
Thank
mean,
you.
just
I appreciate that. Thank you.
yeah, of course. I appreciate the hard work you put in. Everybody here, Michael, you, Kitt, Pit Munch,
Yeah, thanks for
I
the
see
kind
the
words,
work.
bro. Appreciate it.
Of course, yeah. I just see the work that you guys put in. I see the time that you give up to other people. So tap in with the 2026 mentorship and Kitt streams, guys. They'll help you a lot. It's crazy sauce, and it's literally free. So if you're paying for something, I don't understand why you're doing that.
And I'm glad you
Yeah,
shared. I'm glad
that's
you shared that sentiment, because I want to add just one little bullet point at the end of what you just said. I've done one stream where I've taken people up one at a time, and I can tell you it completely disorients me, and it's hard to manage, and I'm not good at it. So I'm thankful that Kitt and whoever else helps him when he does these. It affords me a great deal of relaxation, so that way I can listen to the people that have a question, or if they have a comment or a concern or whatever. It allows me to be in a better state of mind where I'm not having to juggle like all this stuff and who's coming up next and who's going to be, you know, I don't have the patience for that, to be honest with you. I don't want to deal with all that stuff. So I'm glad that you show, and the rest of everyone else that mentions it too. The fact that Kitt and whoever, you know, I know he's had other people in the past help him out. So I like the fact that Pip Munch comes in. She's like a supporting actress in the whole thing. So that's wonderful that it happens that way. And if it wasn't like this, it probably wouldn't be so helpful, and I wouldn't be so willing to be participant in it, because I have help in doing it, and it allows me just to be myself and relax and have a conversation with y'all.
Yeah, the community is awesome. I think the community that you have built, and other people like Kitt have helped to build, is wholesome and a tightly knit community. And I couldn't ask for a better, like, I guess, like a support system, I guess, in my trading, because I found your concepts pretty early on, and I just, it's the truth to me. Anybody who says otherwise is just noise. So
that's what we're
yeah,
all about. That's what we're all about. I want to add, people need their own sense of validation. We are not just ICT based traders, but we are a community of ICT traders, and the folks here trade ICT concepts, and we trade them proudly, right? So there's so many, it's so diverse, just like your personality. Everyone here is their own fractal, their own snowflake, their own fingerprint. And these concepts are algorithmic, and they are schematics. And you, as a personality, can really mold yourself into Michael's YouTube content. And all you have to do is tap in. All you have to do is tap into the core content as your base. That's how it all began, was understanding how important core content is. That's why it's called core content. And anybody, any year that they're doing mentorship, should be looking at whatever year you came in, and then do you understand at minimum 1, 4, 8, 12. Minimum 5. You should, if the longer you're in the market, you need to understand 5. You got to understand seasonality. You got to understand IPTA. You got to understand higher time frames. And I mean, when we're working on a sub 1 minute chart, you got to really understand where these higher time frame levels coming from, where these higher draw on liquidity is coming from, where is the fractal providing some direction. So anyway, thanks, Sense. Jad Trades, you're up next. That was really, really nice thought and feedback, Sense. So high five. Appreciate you, buddy. And thank you, Michael, as well. It's not easy on Front Street doing this, and I know Kitt's such an asshole. Wow, he's such a dick. But I'm here for it. That's the shirt I get to wear here, and I wear it proudly. All right. Just so you know, I ain't got a problem being the one that's reminding folks that we have rules, we have process, we have procedures, and we are trying to make this fun. We're trying to make it easy, casual for Michael, and also for you, the listener. So this idea of being education, being entertainment, being something that you tolerate listening to, and then it is fun not knowing what's going to happen. It is fun not knowing who the next person that comes up, what language do they speak? Where are they from? Is it going to be a troll? Is it going to be all about them? Is it going to be a good question? Are they going to be nervous? Right? Like, so it's fun. Like, we get all of these different personalities, and I love it. So, especially with price going as sideways as it is at the moment. But wow, let me tell you something, Michael. That 13 1240 and 1350 just looks venomous to me. Just absolutely wonderful. Those two candlesticks on a 10-minute chart. Wow.
Who's next?
I
Hello,
feel rude not
everyone.
saying it, so just want to say thank you.
Jad Trades, you're up next, buddy.
Hello, everyone. Hello, Kitt. Hey, Michael. It's about being nervous. Yeah, it's funny because like in life, I'm actually not nervous at all. But like when it's Michael, man, it's you. You gotta be nervous.
Stop that. I'm just
Yeah.
fucking with you.
Hey,
Come
Fight
on,
Club,
Jad.
Well,
Fight
anyway,
Club.
it's first of all, thank you so much for allowing me to speak. I'll just get straight into it. I have a question regarding like sessions and time characteristics, and I've always wondered. I don't know if you've ever mentioned it, Michael, but is there way you look at time where it's like, okay, if 7:30 a.m. does this and 8:30 a.m. does this and 8:50 to 9:10 does this, then I'm expecting 9:30 to do this because at 10:30, and if it does that, then I'm expecting my trade to be at that time. So like characteristics like that, for example. And I don't know if you've ever like explained it in that way, or if 2 to 5 does this and 7 to 9 does this, then I'm really anticipating 9:30 to 11 to be doing this. And so is there a rule base where when this happens at this time, it's 70%, 80% chance it's going to be doing this. So if I see something happens, okay, I'm going to enter. I don't know if you're understanding my question or not, like specific time.
I understand perfectly what you're saying. That's basically my enigma. I have the entire day broken down into different delivery mechanisms and scripts that it should follow based on things that I look for that tend to repeat over and over again. Today, if you watch what I did today, I was implementing some of that. And some of the things I was looking for, there was 2 or 3 things in there that didn't deliver as I wanted, but it was okay. It still kept the trade valid. But yes, if you spend time studying in your own and don't expect to crack this real fast, or for most of you ever, but it's a wonderful study to go in and try to break down every single day. Once you get a model, once you know what you're looking for, the best thing you can do to make you a little bit more astute in reading price and also having an expectation to what morning session should do, what London session should do, what Asia should do, or when Asia does something specific, what does that mean for London? And if that happens in London, what's it going to do for New York? So there's a lot of those things I've taught when I was teaching Forex, and they're like profiles and session profiles. All those things come together to a greater understanding about how you should sit still and do nothing, put your hands in your pockets, don't trade. Or I'm only going to be focusing on London because I think everything's going to be delivered there. The majority of the lion's portion of the move for the day will be in London, and New York will tend to either go sideways or have a retracement into what London was doing and make no further protraction beyond what was already posted in London. So yes, there is a lot of that stuff done in the Forex teachings, but if you go back and listen, I say those things segue perfectly into commodities, and they also segue into futures.
Which videos are you talking about when you say
Month
that?
10. Month 10.
Okay.
Month 10 on core content will give you some idea of some of the daily and weekly profiles. Month 8 is going to give you a lot of your profiles. The indices specifically, he talks about profiles in month 10. I mean, Michael, I didn't mean to jump in to answer.
No, I'm glad you did, because I just don't know. It's been 10 years ago. I mean, like I don't know. I don't know what they are off the top of my head.
Yeah, I mean, we have daily and weekly profiles. You have an Asian range. You have a daily high and low. We have London swing to New York open, London close reversal. You have a London swing seek and destroy. You have London swing to Z day. You have London close consolidation raids on news release. We've got lots of profiles schematically defined by the mentor, and all you have to do is study. Right.
You can stop me if I'm saying too much, Michael, but me and like some other trader who also trades your concepts, we've been studying for 4.5 years, and we always talk about how maybe like this is the part where ICT can't get too detailed into it. Like this is where he can't share. Is that like a detailed rule thematic approach to time? Is that like
a lot of the things around what I do that is unparalleled is going to be relative to time, yes. And that's why I tell everybody, please don't buy my books with the expectation that I'm going to spill the beans on everything I know about time. I won't.
Yeah.
I have some things I'm going to expound on, but you really don't need those things. Like, you don't need them. You don't. But I understand the desire to want it, but I don't want you to think that I'm holding it back just to be cruel. It's just meant for,
No, I
like,
understand. I totally get it. I
it's
totally
not for
get it.
everybody. Yeah.
No, it's funny. Like, if I'm speaking a bit about myself, like, I've been studying you for 4.5 years. There was a year and 6 months where I put like my whole heart into it. Like, I remember I would study 6 to 8 hours a day. So many like tears at night, not understanding, and now I have such a good concept, enough. But till this day, I'm not profitable, and sometimes I don't understand why. And I think there's like these days where I start looking at the charts and calling out every tick where it's like, okay, now it's gonna consolidate 750 to 810, 830 first phase accumulation, 850 to 910 second phase, and a bit of then 930 smart money reversal, all that. And I'm just calling it tick by tick, and then these like I'm in sync with the algorithm. That's when like I'm going crazy, getting goosebumps, having tears in my eyes, and then I do too much. You know what I mean? It's like I don't even, sometimes I wonder like what's wrong, and I think it's having I just trade price action. I think that's what's wrong. You've always said it. You've always said if you're not with so many years of experience, is profitably too, you should not trade like that. You should have one model. And I feel like I've just never sat down and had one model. And
That's what a lot of you folks, you gloss over what I've said so many times in the earlier lectures. And when I was back on Baby Pips, they asked how long did it take for you to figure all this stuff out? I would have bits and pieces of it, and I'd say, oh, I got it figured out. Just like when I make a video about something like the fair value gap or the silver bullet, everybody went out the very next day, tried to trade it with real money, or they tried to trade it with a funded account challenge, or they had their funded account, and they're like, oh, I tried this and it's not working. I literally just taught it last night. You didn't spend any time doing anything with it. But I understand that excitement because I was doing the same thing. Whenever I saw something in price action, look here, I'm like, okay, I see that. And then let me see if it works everywhere else. And it was there. It was over here in this market, that market, palladium, platinum, copper, cotton, lumber even. Who the hell trades lumber? But it was appearing in lumber. So I was like, man, this is, I'm going to go out tomorrow and I'm going to trade with this. And boom, I'd hurt myself, lose real money. So I understand what it's like for you to feel like, okay, I think I got enough to go out and just see what happens. And I messed around and I found out. So it didn't take overnight success with me. It took me literally 6 years of having pieces and then trying to put them in the real market with money behind them. And sometimes it worked. But when I tried it again, it failed because I was forcing something that I didn't fully understand. It just resembled something I thought I understood. And that's exactly what happens with students with my stuff. They watch it one time. They say, oh, I looked at a couple charts over dinner. So I did back testing. And okay, well, how many sample sets have you done? What's your stats that you got on? How many times did it work? How many times did it fail? What was the best drawdown, the lowest in other words? What was the highest drawdown? What was the stop loss that you found that was economical for that model that you're working with? If you don't have those answers, you shouldn't be trading with real money. And I did that same stuff in the beginning. It took 6 years. And some of you guys cuss me out because you can't figure it out in the first 6 months. It's not normal. So you're saying you're still working on it in your 4th year? You haven't graduated college yet.
yeah, 4 years and
You're
like
working on a
7
master's
months now.
degree. Yeah, you're working on a master's degree. It's fine. Nobody goes out of med school in the 4th year and starts cutting on anybody.
Yeah, that's true. That's true. There's sometimes, I don't know if also I'm thinking the right way. Yeah, I call it the tick, where like the market's doing whatever. You call him Phil. I don't know if you know Phil. His name is Phil, or are you just saying that?
His name's not Phil.
Okay.
Hey, do you know Phil from Modern Family? Did you see Wolf Tribes, Michael? He posted like a meme of Phil. I don't know if it's just like a popular guy on TV whose name is Phil. I don't know. It's just funny how there are different memes. The guy Phil, it's being personified really in these memes. It's hilarious.
Yeah, still don't see.
Anyway, go ahead, buddy.
Yeah, there's something like I call it the tick. I don't know, just it's the word, but it's like there's this instance in price where it starts. Like I don't know how to explain it. It's just you see it, but I cannot predict it. I've never been able to predict it, and I can only see it when it's like 60% complete, 70% complete. I can never see it before. I call it the tick, where the algorithm starts its profile for the week. And so like I've seen it happen at 8:30 on Tuesday before. I've seen it happen on Monday, and then sometimes it waits till Wednesday, where the profile starts, the actual accumulation starts, the market maker buy model or sell model. It starts. How can you like, I don't know if that's a thing or I'm just going crazy. How can someone predict that and right away realize that it start, if there is such a thing, like, oh, now the algorithm is playing.
There is, but you're asking for experience that you don't realize you get by doing what you're doing, studying, back testing, and then tape reading. All those things come together, and it gives you that answer to how do you, it's, then you can explain how hard it is to someone that doesn't know how to do it. The answer is you've done enough of it, you got it as experience. There's no lecture, there's no, I wish I could do something as a teacher to make it so you only had to maybe watch a few videos, you know, and be able to absorb it over the course of like 5 days and then simply know it. Because it's very frustrating as a teacher to know. I understand it's frustrating to try to articulate some of the stuff, but I know as soon as you start talking about a topic, I know where you're going with it. And then also I tap into that frustration, because that's what's hard about teaching this, because there are some things that no amount of lectures, no amount of me doing it in front of you, none of that stuff is going to help you get it. It's just you have to be looking through price action and seeing it, and it conditions you by experience and repetition.
Is there
And then over
indications?
time,
Is there
you pick it up.
indications? Like it,
Well, you were mentioning it. You were talking about how you were feeling like you're getting in sync with it, but it's like more than half of the way started. That's progress. There's a lot of students that have no idea how to recognize it until it's done. You know, oh, I can see that market maker model now. Oh, it's obvious now, right? And the reason why they can't see it in the midpoint, what you're describing, if it's 60% of the time, once it's in there, well, that's wonderful. Then you have the second stage distribution or accumulation,
yes.
reaccumulation rather. You have the best of the model. So that's what everybody wants. Everybody wants that part, because that's the one I like to be in. I can afford to not be in the first part. I can avoid the first part of the curve. I could avoid the hassle of being in there at smart money reversal, because that's so hard to do. And then the low hanging fruit, or not low hanging fruit. I'm fatigued. I'm literally it's escaping me now. Smart money reversal, low risk short or low risk buy, and then first stage accumulation or first stage distribution, and then second stage, whether you're going long or short. That second one, that's the one that delivers real quick. It's immediate feedback. And what you're describing, if I understood it correctly, if you can see up to that point, then you should be very soon be consistently able to see the biggest runs in each one of the models.
Yeah. Yeah, no, because I think like with your concepts, they're obviously very powerful, but within the right parameters and the right hands. And I think that's what separates the people who can really make good money from this, and not it's because these concepts, if it's not at the right time, when this, let's say the buy program or the sell program, if it's not already started, it's just going to go everywhere. If you're not at the right day, the right time, it's just not going to work. But then when you're at the right time and it has started, that's when it's perfect. Like it's absolutely perfect. It brings tears to my eyes till this day when I see it. Like it's like wow, wow, wow. And now these days, to be honest, there's just some wicks coming out of nowhere. I don't know what's happening, but but yeah.
I'm being challenged by the same thing. So just know that the algorithm has not changed. It's just they're going in there and they're disrupting everything because they want you frustrated. They want you to make mistakes. They want you to get revenge driven over leveraged, because all that's going to do is put more contracts in the marketplace. And stop listening to these people that tell you they're not going to come after your stop. They're going to come. They're coming for everybody. They're literally coming for everybody right now. So just have that in your mind and trade with the least amount of leverage, and let your development take organic pathway. Don't rush it. You're on the right path. It just doesn't feel like that because you've been doing it for a couple of years and you don't see consistency yet. You're on the same path I was on.
Thank you. Thank you. That means a lot.
You're very welcome.
Thank you, Kitt, for allowing me to speak. Thank you, Michael, for everything you do. And obviously, thank you, Jesus, for having you both here. So, amen. Thank you guys so much, and have a good rest of your day.
You as well.
Amen to that, Jad. I'll just add, yeah, man, be patient with yourself. Self-love and really recognizing yourself on the journey. Like, this is a long path that we're on, and 4 years does seem like a long time, but it's really not. And the person that you become with this superpower, you don't even recognize who you want to be yet with these tools. And you really need to understand the power of these tools so that you can become the person you want to be who yields them. That takes time, that takes maturity, and most importantly, that takes experience. So
100% well said. Well said. Thank you.
keeping her going, keeping it flowing. Oh, we got Dodgy here. We got double trades here. We got Alex here.
3:15 is extraction time.
Yeah, right. Rock on. Sounds great. Double trader. You were up next. Jump in here, buddy.
All right, welcome. Hello, everyone. And I have a quick question to you, ICT, if I may.
Yeah, jump in, buddy.
Sure. Go ahead.
Yeah. All right. So, is there any certain signature or protocol for situation where, for example, we have relative equal lows that are very perfect, that have all of the low resistance liquidity run signatures behind them and all of that, and price will start running towards them, and maybe it will go very, very close to them, but it will fail. And the question is, when is that moment, or what is the cause behind it, behind the scenes, when you will know that they are not running those lows, that they are meant to stay, and then usually they will tear in the other direction. But what exactly is that moment when you will stop looking at or for those lows and look for something else? Because I many times tunnel vision myself on those perfect lows and keep on like trying to even force a run into them. But yeah, is there any moment when you know that these lows are meant to stay and don't try to trade into them, basically?
In a perfect world, let's assume that your price run is 100 handles or 100 pips if you're trading with Forex. And the relative equal lows are in the price action you're looking at. The time frame, we'll just call it 5 minutes. If the market has dropped down half of the range that would be from where your entry would be to where those relative equal lows are, if you measure that, and that's the 100 handles, if it does 50 handles or 50 pips of that range, once it gets down into the lower quadrant, you don't want to see it return back to its half. So as long as it hasn't done that, like in other words, if it gets into its lower, if it's in its lowest quadrant and it hasn't taken the low out or the relative equal lows out, you have to submit the idea that it can go up into half of the lower third, but not touch the midpoint or equilibrium. It's got to stay in a deep discount, but you can't let it go back to equilibrium. As long as it doesn't do that, you simply just let it pan out. But if it starts going back towards half of that range after being inside of the lower quadrant, chances are it's not going to do it. And you watch what I was doing today in today's trade. I was scaling off some because it was doing that very thing. It was spending too much time. It was coming back what I thought was going to snap up there and go to half the range that I had defined for myself. If these things happen while you're in the trade, they're usually warning signs that maybe it isn't going to run down there and take that. It may need to come back to it later on the day. It may be, especially now in these market environments, you may have to sit through a deep retracement and then wait for it to go back in that direction again. But never, ever, ever try to force it. Don't get in an arm wrestling match and say, it's going to do it. And I know if I just stick with it hard enough and I just keep adding to the position, it's going to eventually break through it. That's what will wreck you in this market environment we're in now. So it's either going to do it easy without any stress. If it's causing stress for you, chances are it's probably not going to do it. It's probably like the easiest way of saying it right now, because it's either going to go through it, efficiently and without a whole lot of resistance to do it, or it's not. And if it's not, it's better to get out and say, okay, it's not doing what I wanted to do. I'll just bail on this one and be content with the fact that this type of trading works. It's not limited to just one time or a couple times a month. It's like an everyday thing. So the easiest way for you to fix what you're concerned about is giving yourself the flexibility and the permission to allow price to prove it to you efficiently and quickly, or you know what, I'll take a portion off right now, and I'll just bring my stop down. If it stops me out, I won't be mad, or I'll just close the trade here and just study the outcome, and don't get upset about if it goes through it. Who cares? You're getting experience, but you have to allow for imperfection in the beginning, and you also have to give yourself permission to be flexible. Sometimes the moves aren't going to happen. Sometimes they just aren't going to do it. And it may have all the things going for it where it looks like it should, but it doesn't. Are you going to throw away that idea of trading simply because you have a few of those a year? I would counsel you that would be a poor perspective, because you'll have more winnings following this logic than abandoning it. Does that help, or does that make a little bit of sense?
Yeah. I mean, that's a very good point. I was just wondering what's your actual take on that specific situation, because sometimes it can cause some problems if it occurs. But nonetheless, thank you for the answer. And the last question, if I may, is a little bit like more general, but do the people in the know, the actual smart money operators, have harder time trading? Do they feel playing video games on the IPTA, or they don't really care?
Do they, what, you broke up a little bit, or I didn't hear it well. Do they do what now?
Yeah, I mean, do the smart money operators have like harder time trading also during the wider manipulation from Phil, or doesn't matter at all?
They can get burned, which is why I taught mitigation. An order block that would be used for a long, if it trades down below it, that becomes a mitigation block. So what is it really becoming? An inversion order block. So they use those types of concepts to mitigate things that, if they see it in price action, they're not throwing their hands up in the air and saying, oh man, the hell with this, I'm done, I'm not trading anymore today. They're going to go in and use the things I'm pointing out. But the things I'm pointing out are just things that gets really, really close to the actual thing they're utilizing, which I can't say, here it is, and here's where the algorithm is, and here's where it's at. You know, I can only show you what was bridged with the vocabulary and the language I've given you. This is what it looks like through the lens of candlesticks and charts, time-based charts. So yes, they can get caught offside. Yes, they may get greedy and over leverage and have to fix that, but they're nowhere near to the degree of a retail trader, worrying about whether or not their stuff's going to work.
All right, sure. So that's very interesting to hear. So yeah, nonetheless, thank you very much for your time, and yeah, That
You're very
was it
welcome.
from me for today. Thank you.
Keeping it going, keeping it flowing. Alex, longtime listener, has been up here, but not for a minute. How's it going, buddy? Custom trades.
Yo,
How you doing, my
what's
man?
up, Kitt? Been good, man. It's been a little time, but I was off social media.
That's
I
okay.
tried
I
to,
understand, buddy.
but I was keeping watching next. I was keeping watching Michael stuff. I mean, why Michael all the time? Because I'm not deviating. I like to be on time. Even when I'm busy, most of the times, my life is a busy life. Um, yeah, I like what like Michael shows right about this field guy here. This market has been been really difficult even for me because I'm studying Michael stuff for like 5 years, and it's been challenging, right? Even for me. And yeah, I was taking like small shorts, and I was giving time, to the market to show his hand to me. So I don't know. Even me, I'm finding these difficulties sometimes, and I want to ask Michael. I mean, he know. I mean, I know that he understands that you can have these difficulties, uh, even if you have like 5 6 years. I feel like I'm in Michael's. I feel like I'm him. When I have these bad times, and when I listen to him, I feel like I feel better. I feel like I can do it further without rushing everything, right? Because I was rushing sometimes. Because maybe I was doing something else, and cannot be concentrated on the things I should to do, right? But yeah, I want to ask you, Michael, about when on those times get into it, right? Because you're gonna have good periods, right? They say you're gonna have good periods, like it's gonna awesome, and I don't know, price changes his trajectory, and how you should handle that. I mean, you should size down. I know that, but if it happens, if I size down, right? Let's say I have a bad period, a bad month, a bad, I don't know, something has happened in my life. How should I handle that in a proper way? So I'm not gonna, you know, go too much to raise myself too much into it. That's what I want to know more about that.
Well, the first thing you have to do when there's an emergency and you're bleeding out money and you're in drawdown is you have to stop the bleeding. You have to stop the hemorrhaging. So the first thing you do is stop trading. You have to give yourself permission to at least stop for a couple days. Because if you're angry, if you're hurt, if you are embarrassed and ashamed, all those things are triggers for us to go in and do something. And usually what we do is we reach for a bigger weapon, something bigger, something more blunt, much more sharper, much more caliber, higher caliber, and we translate that into bigger, more frequent trades to get out of that feeling. Because we equate that if we do that and we're able to clobber the market and pry the money that we'd lost by our own actions away from the marketplace, that means that, yeah, it was just something that was temporary, but I'm still a warrior and I'm never going to be afraid of having this happen again, when that's not true. But that's the comeback story we tell ourselves. And I did that a lot as a 20-year-old. The first thing is stop trading. Do something else away from the charts. You have to distance yourself. And what that does, it reminds you that trading is not who you are. It's what you do. And if you keep yourself grounded for a few days, minimum 3 days, preferably a week. Some of you may require longer than a week. It's going to be hard for you to do that, but it's good medicine for it to happen. When you eventually get through that time away from whatever you arrive at for your, I guess, measure of discomfort, whenever you put something on yourself in terms of drawdown or struggling and you're getting frustrated, you're spending more time worrying about getting back to doing it right, and you feel like it's a race to get to it, that's not a time to go back into the marketplace. So you have to let that go. And by doing something like a different hobby, don't watch my videos, don't look at price action, don't go on social media and look what everybody else is doing. Prove to yourself that you have discipline to keep yourself away from it. If you can't do that, that proves that you're not equipped to go in and trade, because you're going to reach for the first thing that looks like something to trade on. And chances are it has nothing to do with making money. It's just something for you to distract yourself from the pain. It's distracting you from the discomfort of what you put yourself through. And you want to get to that realization that it was just temporary. When spending time away from the market, away from my content, away from the community, away from social media and the markets, you ground yourself and you realize, oh yeah, I am that same person. Before trading, I liked doing all these things too. I love my family. I love my friends. I love the hobbies that we did that were not market related. So yeah, I'm okay. I'm going to be okay if I don't go back there for a couple days. The market's going to be there. The concepts will still be there, but your frame of mind won't be where it needs to be to use them correctly unless you give yourself a break. And by grounding yourself like this, it allows you to come back with a fresh perspective. You're not in a vendetta mood where you have to go out and exact revenge on something, and you end up personifying the market. Just treat it as a very slow progress where you go back down to 1 micro and 1 trade per day. And do that for a couple of weeks to get yourself back into the swing of things. And over time, when you get a little bit more acclimated to what it is you're doing again, and if you're not feeling impulsive, then go back to whatever you were doing before you hurt yourself.
That's amazing, Michael. Thank you a lot. I really appreciate it. Be the Lord Jesus Christ be with you always.
Thank you, brother.
Great question, Alex. We got a few more minutes. Ty the Fly Guy, come on up here. We got lots of folks here. I want to bring up some different folks. Don't get me wrong. If you don't get to come up, we're trying to bring new folks up. I understand. So just understand we're trying. Ty the Fly Guy, you got a question in here, buddy?
Hey, how's it going, everyone?
Pretty good.
I I did have a question, but I did want to piggyback on something Michael said earlier. I think when he was speaking to Jad, and of course the rest of the community, back testing is a real thing, especially for those that are newer to the charts and looking at them and studying them. When you find your model, before you even start trading, before you even enter anything, you study and you look and your eyes get accustomed to it over time. Like, for example, just for a quick comparison, I mean, I don't have any personally, but babies, children, there's this whole thing called schemas. They're used to looking at their parents, and they're used to their parents' faces. And when they see somebody else's face, it's different to them. Sometimes they might cry, sometimes they might laugh, whatever the case may be, but they're used to their parents' faces because they see them all the time. So when you see your setup all the time, day in, day out, or whatever, whatever you trade, when you see it happen over and over again, your eyes get accustomed to it over time without the feelings getting involved, without the pressure of being right or wrong. You build confidence when you do that. And that's something that can go a long way, especially for new traders. Now to the question though, I did have a quick question. It's referring to like end dogs, new day opening gaps.
Oh, the end doggy dog.
I love them. I love them. So, I was just wondering, like, because I always expect consequent encroachment to hit, at a certain point, at a certain time of day. But when price like just touches like the top or the bottom of said end dog and just runs away from it for days, can we still expect price to come back to that point at a later date, or is it just like, man, let's just not worry about it anymore?
I do if it's in the last 20 days.
Awesome. Okay. Sounds good.
When we return back to a more docile market condition, should we ever, and I don't know if we ever will, but I'm submitting to the idea that it should eventually, and I don't know when it will. So every day I just treat the market for what it is, and I use what it's presenting me, and I either find the opportunities or I sit still and don't do anything. But when a normal market environment is there, I'll go back as far as 60 days, look back. If it makes sense in the market structure, if it makes sense on where I think it may trade for that daily range. One of the things that you should be doing also, if you've been doing this for a while, you're a little bit more versed. Some of the newer students, this is not going to do anything but be like a quagmire for you. You'll get bogged down pursuing something you don't really fully understand. But for the advanced students that have been with me for a while, who might that be? Actually, charter level that actually went through 2021, 2020, 2019, 2018, 2017 to 2016. All of those individuals would fit this bill. When you look at price action and where we're at right now and where we may go for the weekly range, where it may gravitate towards, go back through the last 20 days and find what NDOG, new week opening gap, opening range gap, first presented fair value gap, which one exists in that projected range you anticipate seeing for the week. Go back, and by just simply doing that, you had the highest degree of probability PD arrays already predetermined. You just got to wait for time to get there. And then the further you go back, when it's a better market environment, you can go back like that for 60 days. 60, 40, 20. But living in that little universe of 20 days, like, I mean, it's handed to you on a platter. It literally is like, here it is. You just got to be there in front of the charts when it gets to it. Know where it's going to draw after it goes there, and it's done. Like it really is that easy. But it's not easy knowing how to manage that data, how you're going to utilize it, where's the draw going to be for the weekly range, where do you think it's likely to go, and maybe the weekly range is too much for you. Well, do it for the daily range. Where do you think it's going to draw to? I gave you the target today, and it went 100 handles or more than where I thought it was going to go, but I don't care. I'm not going to sweat that little bit of extra movement. I mean, I'm not going to beat myself up over that. But anticipating where the market may reach for, go back over the last week and say, okay, in the last 5 days, what first presented fair value gap, what opening range gap from regular trading hours, what new day opening gap, new week opening gap, which of those things exist in the direction trading lower into those relative equal lows I gave today at 26,805. Every PD array that you can find in the last 5 days, if it's in that range from where the daily high was, I'll shorten to that target as relative equal lows, study how that price action was used today in the range, and you'll see things that you didn't see before, but they're always there in the chart. And my experience yields to me that these things will tend to repeat. So it's advantageous for me to keep a good record and log of them, and I write them down on my little notepad. And I have those things available to me, so that way when we traverse to one of them and goes through it, what's the next one in the order? Well, below that one, it's the first business fair value gap from a Tuesday or a Wednesday, or it's the NDOG from this, that, and the other thing. So by you managing these things, you'll see that the trades are not materializing out of the blue. They're literally going to things I've already taught you, but you just aren't spending time basically collecting them in a useful manner. Where you think it's going to go from where it is right now, what PD arrays exist in that. If you're looking at anything outside of that, you're doing too many things and collecting too much useless information. If the PD arrays are outside that range that you think it's going to be trading in, why are you spending any time worrying about them? Focusing and limiting your. I'm sorry?
No, that's real.
Yeah, so I mean, it helps. It gives you framework, and it provides a way of clearly anticipating when the price moves are going to happen, and they're not going to be a surprise to you.
May I ask a question to what you just said?
Go ahead.
Sure.
You just talked about first presented fair value gaps, NDOGs, and new weekly opening gaps past 20 days. But when you put them all together, let's say we're not at all-time highs, wouldn't there be too many of them, like first percent fair value gaps for New York, for PM, for Asia, for London, and you're putting those, isn't your charts just going to be full of lines at that point?
When we were going through that real nasty consolidation on the daily chart for the indices, when it's like that, yes. But then I've also taught you, look at the last Friday and Monday of the last 2 previous weeks. If you just use those and your common everyday new day opening gap, each one that forms, it's not going to be a whole lot. So you have to be able to manage, like I said, you have to manage your information and your data. But when the market's moving around and gyrating around, looking back 60 days is not going to give you more things that you'll be able to handle it, trust me. But when it's in a consolidation like we have been recently, there's a whole lot of overlapping. So you have to reduce it, spend much more time trying to eliminate redundancy. So if there's several gaps that are overlapping, get the highest high and the lowest low of the whole group. Divide that into quadrants. It's done. You're going to blend and create a hybrid out of all those coalescing, they're all congregating around the same unified range. So wouldn't it make better sense to say, okay, instead of doing all these individual lines, if I'm going to use the last one in the last 5 days or the last 20 days, if they're all grouped around in a very specific range, what's the highest high and the lowest low? Divide that range in half and by the quadrants and octants, and then you're done. You're done, because the algorithm is going to refer to all of them. But if you're going to focus on having it much more user-friendly visibly on your charts, you've done so by doing that.
All right. Do you use, have you talked about true month open and true week open, same lines in past 20 days?
No. But I don't think you understood what I just said.
Yeah, I don't think
You
so
should have
either.
been like, because
That's a follow-up.
you should have been like, oh shit, because that's what that was. That was an oh shit moment. That was one of those that just went right over your head, and people are just not going to pay any attention to that. But when you have all of these PD arrays and ranges sharing a specific range, if you create a hybrid of that and just use the furthest extreme high and the furthest extreme low of all of those and grade that, you have literally removed all of the extra work of keeping all that stuff on your chart. And it'll be just the same as if you just used the most recent ones. Don't take my word for it. Go into your charts and go back into all these consolidations we did, and you'll see what I just told you. It's voodoo.
Okay, thank you.
You're very welcome. And now, again, you don't have to buy the book because I just taught something there.
Is there a term that you would refer that to? Like, is that clustering some of these arrays? I use the term cluster. I don't know if I'm asking you if that would be an official term or not. I don't know.
No, it's not. I don't want to use the term because, like I said, every time we do a lecture or something, they're taking AI and they're creating these little pamphlet books on Amazon. Like, seriously, look at them. Every week there's something new. ICT's bullshit this, ICT bullshit that, and they're just using AI to create the book and put it up there for quick profit. So it's a lot of things. I'm teaching conceptually, but I don't want to say the name because they're in the rush to have it in print first. And that it's this little thing that's pissing me off. So I'm talking about it conceptually, but I taught it. You don't need to know what the name of it is. That's what difference does it make what the name of it is? If I told you, look at the range high and range low, break it down. If it's a hybrid of all these ranges that share the same space. Just remove all the ambiguity and the extra stuff and remove all the chaff by taking the highest high, the lowest low, grade it, and then use it just as if it was just that alone and nothing extra. And you'll get to the exact same thing. If it stays in the lower half, well, what is that? That's premium sensitivity. If it gets to the upper half, if it trades down to the upper half when it's bullish, what is that showing? Discount sensitivity. And you don't need to worry about all the other little extras that would be inside of that bigger range. It makes your job a whole lot easier by looking at a very specific range.
You said you could use that to the last 5 days as well, not just 20 days?
Anytime you see it, like a grouping of NDOGs, new week opening gaps, regular trading hours opening range gaps, if you start seeing price, and we're going to eventually get to a point where we get into these long extended consolidations again. And when that happens, it's by default, it's going to happen. They're going to share. They're going to be basically showing you the same kind of ranges. Just use the furthest extreme high and low, and then grade it out, and you'll have everything you need, and you don't have to worry about having multiple specific lines. This is the best one.
Amazing.
It will be when you see it.
Bang, bang. Wrapping up, last few minutes, Michael. Have we reached an end? One
We can take
more?
one more.
All right. Let's bring up Diamond. She's been up before. Diamond, how you doing?
Hey guys, thank you for having me. Michael, I just have a quick question. Well, protocol, Diamond Leone, Palm Beach, Florida. I'm very new to this, and I'm still studying. Let's put it that way. But Michael, I've been dying to ask you a question. Do you have a favorite PD array that you like to use, and also for a beginner? Is there one that sticks out to you that you would say, hey, that one's kind of more easier than the other ones? Do you have any thoughts on that?
My favorite one I won't teach, but as far as a new student or someone that's just starting out, I don't feel comfortable doing it, because every time, like when I first taught order blocks, I thought that was that should be real easy. And then I saw how many people struggled with it.
Okay.
And then that frustrated me as a teacher.
Yeah.
I think in my own kids, let's say it this way, with my children, the one that they see easiest, and the one as their dad, I spent the most time, going through all the ones I'm trying to teach them. The fair value gap is the one all of them found the easiest. It's the most visually selecting, and out of all the price action you see on the chart, that fair value gap, I can see that, Dad. I can see that.
Okay.
So I think it's a fair assumption for as a response to your question, but I will tell you, it's not the perfect response. It's the best one, but it's still not for everybody. Some people don't see them for whatever reason. They just can't see it until after it's happened and prices already moved.
Well, let me ask you this. I love how when you are doing your commentary live and stuff, and you use a fair value gap candle that starts a run. I remember seeing you say, okay, this is the one that started the run. And is there a video within your library? And probably Kitt, you would know the answer to this. I don't know. You're so good at remembering all that stuff. My God, it's so impressive. But I was just curious, is there a video within your core content that specifically goes over the fair value gaps that I could study? And
Month 4.
Month 4. Okay.
Month 4.
You are awesome. How did I know you were going to do that? And then last question.
That's funny.
Yeah, I know. You're so good.
Hey, that's funny. Hey, real quick, Michael, I know you're going to have to
Okay.
leave, but I wanted you to know that Brima is to our right, and he was the gentleman that we had spoken about early today. I know you got to wrap up. And
I will
Diamond,
stay.
yes, okay.
I'll stay over.
Very good. Thank you very much. Just
Okay.
wanted to mention that because we brought him up.
Okay, and then real quick, this one. When you said today that you had looked at the Asia session, and I'm sorry, I'm not quoting you exactly, but it was something about the Asia session that you looked at, and that information was able to tell you that we were going to maybe come back down into those levels. I think it was the 26,805-ish level on the NASDAQ. How did you know that? What? That was so incredible. But what was it about that Asia session that you knew that it would come back down there?
I'm going to cover all that in a market review today, because I'm sure everybody wants to know what I was doing to get in the high of the day and whatnot. I'll cover all that. But I make one point about the videos on the mentorship about the fair value gap. That's the entry level perspective of it. And it's very helpful. A lot of people's made wonderful careers out of trading them, and it's been enough. What I've been doing last year and this year, I've been over real-time price action, giving a little bit more detail, because in a book, I can talk about something conceptually, but it's altogether something different when you're watching it with me and I'm telling you, see what it's doing here, see how it's doing this, and see how the bodies are staying right there. Even though at the moment, the candlestick may be bold and going all the way to the high of the gap, but it comes back down below consequent encroachment, as it should if it's bearish. Those types of things, I could show a before and after picture that are still in a book, but that still picture doesn't really communicate the depth of appreciation when you see it live, when that candlestick's breathing and the ebb and flow of its
Right.
up and down movement, it's like, wow, this stuff is really working. It really works. That's what I've been trying to cultivate in the understanding as a student watching my stuff. It's not just simply look at these three candles. There's a fair value gap and buy it. This is a fair
Right.
value gap, sell it. Not every gap is useful. Not every single one of them are useful. There's lots of other fair value gaps that you see me ignore. But the
Right.
ones I'm talking about are working. And that's what I'm trying to teach this year. So that way I can feel comfortable when the book hits market, you'll have a greater understanding versus just simply looking at static charts and pictures and be like, I still don't get it. You'll
Okay.
have real world examples of me calling it when it happened.
Okay. Well, thank you so much, Michael. And I mean, I am just your biggest fan over here. And thank you, Kit, so much for doing for doing these streams. We really appreciate you both. Thank you.
Thank you.
Brima, we did not forget about you. Last but not least, he's coming up. Brima.
Sounds like a character's name in a game.
It does.
Yeah, I'll try my best not to.
You're like, after that introduction, right? Hey, Brima, just to lighten up the load, everyone, real quick, if you have a speaker tag, what's up?
What's that?
Thank you. There you go, Brima. Jump in.
Anyway, yeah. So I just posted the charts that I wanted some help with. It's two charts just under my 38 minutes ago. Don't know if you can see them.
I'm looking. I
Yeah,
don't see it yet.
I don't either.
Just spam it because who cares? Just keep doing it until we see it.
Relevant and then recent.
Yeah, I'm doing the same thing. And
Yeah,
I'm not
yeah,
seeing it.
yeah. I don't see it though.
Give it a chance.
Yeah. Dude, Brima's been hard at work.
Does anybody else see it? Because I don't.
Let me just post it again.
No, I'm looking as well, but I don't see it.
Just give me a second.
Brima, buddy.
I feel bad because I'd be like, if this was me, I'd be like, man, come on. You guys are messing with me.
X is undefeated. That's all we got. It's universal for all of us.
Brahma, can you tag somebody when you post it?
Yeah, just posted it again. And,
yeah, but with a tag, just tag Michael or Kitt.
I tagged you, Kitt.
Can you send it to Kitt just directly and then Kitt, you post it?
Yeah, we can try that. I mean, Brima, you've got my DM, so you can try that too.
This is odd. I don't see it.
Tag your ACT on the comments for the.
Sometimes it takes 3 minutes to show up.
Maybe that could be it. Okay. Oh, it says look. Go to. Someone said go to his account. So click on his name, and then it should be on his page. Like it's not showing up. Oh, is it the white? Is it the white chart, Brima?
Yes. The white chart. It's two
One,
charts side by
two.
side. And then it has like 1, 2, 3, 4, 5.
If Y, then X. Okay.
Yeah.
Michael, he posted it on his page. So
I can't pull him out of the list of people
okay,
talking.
I got you.
Thank you.
Here, I got Brima.
No, this is making it more. But I tried to tag Pipmunks.
Okay, do you have it?
Yeah, I'm gonna try and post it here. See if I can't post Brima's 1, 2. Brima. It should be posted right there. Let's see. 3, 2, 1.
I see it.
Mine is posting. There's my post right there. Brimo with the 2 pictures.
Okay, I can see yours now, Kitt.
Okay.
I don't see his.
Yeah, that's okay. It happens. I mean,
Yep.
X is undefeated.
Yeah, so there's
So ask your
one
question,
of
buddy.
so
Which
there's
chart should I look at first? The one to the left or the one to the right?
I don't know which one is to your left, but there's one which has sell side liquidity and buy side, but one has only buy side and uprising.
Okay,
So
I'm looking
the
at the one with
one,
the sell side.
yes, that one. So see the 2 fair value gaps, the 2 bases which are labeled if Y then X.
The blue ones.
Yeah, the blue ones.
Okay.
Yeah, so in recent lectures, there's a way you've been explaining how to use the fair value gaps when they're stacked like this. And then also the of importance to you, it's the one just before highs are taken. So those 2 meet that requirement. So when I'm looking for like higher prices, and then there's this thing where it does not really support the lower one first and then the upper one. So what I mean by that is there's a lecture you talked about using the lower one as your decision making PDRA and then the upper one as your execution one. So when it fails like this on the first instance at around 12:30, because I was still looking for higher prices, it fails like that, and then the lows are swept, and then it now rushes higher to support where it's written now if X and then Y. How do you look at the candlesticks when they're forming and know, okay, this is probably likely to still, even though it gave a response in the first instance and went higher and even above the second fair value gap, within the price action and what we're seeing, like when it goes below the lower one, and then
When you say
goes
the lower
below the
one, that's where
consequent
you have it
encroachment.
labeled as X.
If X, yes,
Okay.
yes. The first instance at around 215 to 20. So if it goes below the consequent encroachment of that first decision-making fair value gap, and then when it goes above and supports the fair value gap, supports the last candle, which just has a wick on the high of that fair value gap, but it still goes and runs everything lower below the decision-making fair value gap. At that particular point, what goes through your mind to help you decide whether you're still going to trust it to go even high and use the then Y when it does that the second time to get to the buy side liquidity? I don't know if it makes sense.
Well, using what you have here, the fact that we went down below at what is it, 20 minutes after 2, 14:20. See how we had the candlestick bodies pierce the low of the X fair value gap?
Yeah.
Okay, that right there is, initially it's problematic, but then price goes higher, then it trades back down, but then the bodies also, again, are in the lower half. So we can't use that fair value gap. We got to look at the one that you have X labeled as Y. So we're assuming that the 1:15 to 2 o'clock relative equal highs, that buy side you have noted, lunch hour.
Mm-hmm.
Okay. When it traded up to the Y fair value gap, when it rallied up to that one, it doesn't give you much range. So that wouldn't be a trade I'd take, even though the relative equal highs are there. It doesn't justify the trade because you are still looking at a fair value gap that was on the lower one, X, that showed a willingness that it wants to go lower. And you can see it doesn't get to the relative equal highs. It comes back down lower. That's why I teach you, watch those bodies, because the bodies will tell you if it's going to come back for unfinished business. And that, what is it, 220, 1420. That lower close on that candlestick tipped you off based on my concepts and logic of order flow. It was going to come back down below that. And you can see it went up, it got real close to those relative equal highs, but then went down and washed out the low made at 20 minutes after 2. Then the same thing there, the bodies are below that X fair value gap that you have labeled there, but then we get to the upside of it and we move outside of it. And then we have that move where it goes up to the Y fair value gap. The lower portion of that, it's clean. It goes right into it and goes to the high of it. And then they start putting bodies down around consequent encroachment, but they're not touching consequent encroachment. So at that point, you can anticipate it running to the relative equal highs, but you have to at least put your stop loss below consequent encroachment of the X lower fair value gap, because it can come back down into that inefficiency that's bridging both X and Y's fair value gap. And you have to allow for wicking. And in other words, I would not have used any of the things that are here for a trade because of the things I've highlighted here. The bodies were pushing down below X's low on that lower fair value gap, warning that it could go lower. So even if it was to be utilized by me, say I just wanted to take a gamble, which wouldn't make any sense, because if I'm trying to buy the consequent encroachment of your Y fair value gap, the range at which it moves just to get to those relative equal highs isn't enough to justify the trade stop loss down to the lower fair value gap. Does that make sense?
Yeah, that makes a lot of sense, because what has been happening a lot in my trades is that exact thing. I try and enter with the second fair value gap, the Y, but most of the time my stop gets run because I place it just in the fair value gap in between the two.
In these instances, if you're just going to tape read, that's productive. Just getting a read for, okay, I want to see now that it's performing as it should to continue higher with the price action that's inside of Y. But I wouldn't take that trade because the bodies are suggesting it might go lower on the 2 times it went below the lower fair value gap that you have labeled as X. So it would be just an observation if it was to go and take those relative equal highs, which it later does. It would be just like a moral victory. Like, okay, it was neat to see that, but it wasn't an executable condition. It doesn't permit me to take it because the reward versus what I would have to assume as a risk or stop loss on it isn't economical for me to take it. But it's still noteworthy to study, and it behaves certainly, but it wouldn't be an executable position for me. Now, if that fair value gap, let me say this, if that Y fair value gap that you have labeled was higher and it was laying over top of that swing high that formed between the low at 1420 and what is that? 3 o'clock low or 1500 low, that's a breaker. So if that Y fair value gap was laying on top of the last up close candle in that swing high in between those 2 lows, and the relative equal highs were, higher up to get to, that would be a wonderful area to then use that criteria. But because it doesn't justify the breaker here, and in the range is too close to what your target would be with the relative equal highs, it's a pass. You wouldn't take that as a trade. I hope that makes sense, but I mean, that's the only way I would have used the Y if it was bridging and sharing the same space with the bullish breaker.
Yeah, that makes sense. That makes sense. So in the first image, which has like 1, 2, 3, 4, 5 lows labeled 1, 2, 3, 4, 5, there's a wick just above the fair value gap.
Is that the second chart? I don't see any numbers on it.
Yeah.
Okay.
Just the second chart.
I don't see any. Oh, I got to zoom in. Sorry. Okay, I see him. What about him?
Yeah. So can I use the same concept of just layering the PD arrays and using a lower one that's in an area of interest, but I might not still have the confidence to get in using that PD array, and then just use any other PD array that I can confidently see forming and can see the levels. Like just here, you have the last the X fair value gap, which is supposed to be an inversion fair value gap, and then the Y, which is a wick, which is graded with the consequent.
Let me save you a lot of trouble. Okay, what you're showing me is yesterday's price action, and this is one of the things that I see a lot of new students try to force a imbalance and then force it to yield to a logic that is showing you it won't do. And what do I mean by that? You have your X fair value gap labeled, which is a buy side imbalance. I'm sorry, sell side imbalance, buy side inefficiency, or down closed candlestick. That's what you're highlighting, and you're carrying that through. The logic I teach with inefficiencies, okay, you do not want to see a lot of candlesticks inside of them. And look at what you highlighted here and how many times and how many candles are inside that. You see it?
Yeah.
Okay, so right away, that tells you by the time you got to your number 2 candle that you're putting a number 2 under, you have already spent way too much time in there to be a valid PD array. It's just a common inefficiency. It's not going to do anything for you. That's why you see all this coloring outside the lines. The bodies are all over the place. Like it's a heart attack, basically, is what you're looking at. I mean, this is an EKG of someone having a heart attack. So you don't want to look at simply because you see the SIBI there and say, well, now it must bend to this logic that Michael said, because I have drawn it on my chart, so therefore it must yield to me. No, when you see all these candlesticks inside there, you need to abandon that one entirely. Look at the liquidity pools around that, but as far as the inefficiency or the aspects of utilizing that specific candle as an inefficiency for the purpose of inversion fair value gap, don't do that, because you're making a very, very bad mistake. And I'm not trying to talk down to you, but it's a bad mistake by doing it, because you're forcing the same logic that would exist in a properly engaged inefficiency where you get 1 or 2 candles, maybe one return back to it once it leaves. That's normal. But here it's spending way too much time gyrating inside there. And yeah, there's a couple different times it runs away, but it went lower than it a few times, even with the bodies. So none of that fits the criteria I teach with the PD array. So you're trying to force something that would not be profitable. Let's just say it that way, bluntly. It would not suit or serve you well using this for that one.
Okay, thanks a lot. All my questions were clearly answered. Thanks.
You're very welcome.
Thank you for hanging out this long, Michael. I mean,
no problem, bro. I am tired though.
yeah, bro. I feel you. I do.
I'm not sure if I'll be doing anything online tomorrow. No promises. If I do, you obviously know that in the morning. But if I don't, I'll probably end up doing something on Saturday, maybe shotgun Saturday, something to that effect. But if I do something tomorrow, I won't be doing something on Saturday. So it's one or the other.
Okay, I mean, that'd be cool. I mean, Shotgun Saturday, I know tons of folks love that. I mean, that'd be great.
Yeah,
So I think if
everyone
anyone
loves
could
that.
vote, I think the community, we could pretty much voice for them. Everyone would love a Shotgun Saturday if they knew ahead of time it was
Yeah.
coming.
Yes.
With a probable 1 troll tweet from Michael tomorrow.
What's that? I'm sorry.
Yeah, what was that, John?
I said with a probable just 1 troll tweet from you in the morning.
Well,
Yeah. It's a bad morning.
the upside down gorilla just kind of looking at you funny.
The day starts with "It's a good morning," and then the second tweet is like, it's just attacking some guy or some shit.
Anyway, folks, it was fun hanging out. I'm going to go eat and grab something in terms of a stretching routine and relax the rest of the evening. I'll catch up with you guys when I do.
All right. Have a great one, Michael.
Take care.
Take care.
Bye, everybody.